Hello everyone and welcome to today's Market Snapshot. My name is Craig Erlam, Senior Market Analyst at OANDA. Let's start with a look at the market so far today, and in Europe we are seeing indices trading down around 1%. The US is due to open in about 2 hours time, and markets there are pointing to a marginally lower open. I do think this is potentially just a case of a little bit of risk aversion ahead of the FOMC minutes tonight, which I'll touch on in a second. We are seeing broad-based declines in Europe, but really compared to some of the gains that we've seen as of late, they are still actually relatively small. In the currency space, we're seeing a little bit of reprieve for the Japanese yen. We are seeing it range bound against the euro and the pound. I think some of the reprieve is really coming against the dollar, which we saw yesterday. It actually the pair dipped below 100 for the first time in a while. So I think we are just seeing a bit of reprieve in the yen here. Elsewhere there isn't too much to touch on. We're seeing a bit of declines in Brent and WTI, down around 0.4% at this moment in time. But again, given the gains which we've seen recently, I do think this is just a bit of risk-off reprieve. You'll see one of the pieces, or a couple of the pieces I've written on Brent crude recently. We keep highlighting these massive levels of resistance, and yet it keeps pushing through them quite comfortably now. This can quite often happen. I do think Brent crude is trying to establish some form of new trading range high. I'll be surprised if it breaks through $50 a barrel, but I've also said that about a number of other levels, and again, it's just pushed through these levels with relative ease. I do, again, going back to this, we are seeing maybe a little bit of momentum being lost around the $49 a barrel level. So if we continue to see it push high and we continue to see that lacking momentum, then that may suggest that the upper bound here is around $50 rather than a little lower where some of the key levels could have potentially been. But again, it'll be interesting to see how these develop. We are seeing a little bit of negativity, a little bit of downside in Brent and WTI today, but again, these moves are relatively marginal. In terms of today's key events, I'll just touch on those now. We'll bring up the economic calendar for you, and as you can see, there really is two key events today. The first one was the UK jobs report. Important to note that two pieces of this data came from prior to the Brexit vote. So this was the unemployment rate, which remained at 4.9%, and average earnings, which rose in line with expectations at 2.3% excluding bonus and 2.4% including bonus. The claimant count change, on the other hand, was actually collected in July, and there was a bit of a positive surprise here. The claimant count actually fell by 8,600 rather than the 9,500 rise that was expected. I think the economists and markets were anticipating more of an immediate impact of the Brexit vote on the jobs market, not necessarily on job losses per se, but potentially fewer hiring opportunities to cover what job losses there are, and this doesn't appear to have materialised quite yet. It is still very early post-Brexit. This data was collected around the middle of the month, so only 3 weeks after the vote. I think most people are expecting to see more of an impact in the coming months, and maybe just the immediate impact is just not quite as severe as some will have anticipated. Mark Carney and the Bank of England, of course, are anticipating unemployment rising to, I think it was around 5.7% as a result of the vote in their latest projections, although of course they have been wrong on numerous occasions in the past. But I think the pound's been given a little bit of a boost, or it was initially after, on the back of that data. The other key event you can see today, aside from the crude oil stock exchange for those of you who trade oil, is of course the FOMC minutes. We'll also hear from James Bullard as well. Worth noting on the FOMC minutes, the statement from the last meeting. Now, most of the language from the last statement was largely in line with what we've had previously. There was no press conference following the last decision, so everything really hangs on the statement and then the minutes which are to come. One of the key phrases from the statement itself was the fact that the Fed did believe that the near-term risks to the US economy had diminished. It'll be interesting to see from the minutes themselves what near-term risks this refers to. Is it the fact that they don't believe that the Brexit is going to have as big an impact on the economy as the Chinese situation easing to an extent that they don't see any risk here? Is it in relation to Europe and maybe the Italian banking system, the risk of contagion? Or is it more domestically that it's referring according to. It'll be interesting to get more information on this, especially in light of the fact that the Fed has very much come back into the forefront of people's minds in the last couple of days, following comments from a few different policymakers. We heard from John Williams, who's a non-voting member of the FOMC this year. He raised the possibility that the Fed could consider changing its inflation target, raising its inflation target due to the sluggish growth which the US economy is experiencing, maybe suggesting that current economic conditions warrant a higher inflation target, potentially raising concerns that the Fed appears to be, the US economy appears to be heading towards the inflation target, which would warrant a rate hike, and maybe suggesting that he therefore doesn't believe that the economy itself warrants a rate hike, even if inflation is rising. It'll be interesting to see if this sentiment is shared by other members. It's certainly got a reaction yesterday. We got a sell-off in the dollar on the back of this, potentially again suggesting that people are maybe believe that this is a view that is shared by other policymakers. It was shared by one other policymaker yesterday who spoke out yesterday afternoon. He also suggested that this is something that could be visited at some stage. That was his name actually escapes me right now. Dennis Lockhart was the man who suggested that this is something which could be looked at by the Federal Reserve. Someone who we also heard from other policymakers, another policymaker yesterday who suggested that we could actually see at least one rate hike this year, if not more than one rate hike this year, or at least two rate hikes by the end of 2017. Again, this was another view that was shared by Dennis Lockhart. So really mixed messages coming from the Fed. Yesterday, although he also did suggest that it was too early to start contemplating raising things like inflation rates. So maybe there's not a consensus view at the Fed, but it does seem that there is potentially murmurings of a belief that the inflation target alone isn't correct for the current economic environment. I don't expect this to be something that appears in the minutes, but maybe this is something that Bullard will be questioned about today, and other policymakers will be asked to address during future comments. While the minutes today I do think are going to be very important as far as today's investors are concerned, I think there is going to be more of a focus at this stage on Jackson Hole next week. Janet Yellen is due to speak at Jackson Hole later on next week. Given that the minutes have come prior to the GDP data being released, prior to the latest non-farm payrolls data being released, I think there is going to be a certain view that this number is potentially maybe a little bit outdated, and it doesn't take into consideration the current economic environment, and therefore there'll be a lot more focus on what Janet Yellen has to say just over a week from now. It is interesting, though, that what we are seeing in the Fed funds futures is that markets are once again pricing in a rate hike for December. This does change quite frequently. It is very volatile, but based on the comments we've had in recent days, it would suggest that the markets are now currently anticipating in a rate hike in December. Yeah, we've seen previously how reluctant the markets are to price in a rate hike in line with Fed expectations, so I think it may take very little for this to go back to the status quo of maybe around March to June next year as far as the market is concerned, unless the minutes themselves today are particularly hawkish. To get more in-depth news and analysis from the MarketPulse team, check out MarketPulse.com. There's a number of great articles on there, particularly relating to the Fed today. There's also another great article on there from our new analyst, Jeff, and he wrote a great piece on platinum and particular inverse head and shoulders, which he's highlighted on here. So I recommend you check that out as well. You can also find out more about OANDA and sign up for a free demo account at OANDA.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.